Good afternoon, everyone. Good morning as well for those of you joining us stateside. Thank you all for logging in and joining us for our FinTech Market Update webinar, where we will share our most recent FinTech updates and insights in terms of what we're seeing in the markets, funding-wise and M&A-wise. And also, we will have the pleasure of having three companies present that sort of span and operate across fintech within insurtech, investing, and data. For those of you that don't know me, my name is Claudio Alvarez. I'm a partner here at GP Bullhound and head up our fintech practice. And alongside me will be my colleague Adam Page, presenting some of our insights as well. And you can see below our guest speakers, David Pope from HooYu, Roman from Ottonova, and Victor from Plum. So I think without further ado, why don't we go into our FinTech update, please? Yes, so I think it's no surprise that 2020 was actually one of the better years for FinTech. In particular, a lot of the performance that was driven in the public markets was mainly due to the digital shift and, of course, the payments category being able to capture the lion's share of that movement coming across from either not using currencies anymore and people buying more and more digital goods and using content online, which online payment mechanisms, mobile payments took advantage of as well. But nevertheless, I think what we've seen in Q1 is actually those valuations coming off the year-end highs, but still relatively robust if you look at them from a historical point of view. And I think that one of the main things driving that correction in the market is investors' concerns around inflation. So therefore, investors taking another look at sort of the growth expectations of some of these shares and perhaps re-rating them. But nevertheless, I think we still see quite a lot of demand for these sort of fintech businesses, given that the underlying dynamics and performance of these businesses is still very robust and strong. And we're seeing that through and through, particularly, again, in the payment space, and also now around the lending dynamics. And we'll see that in the next slide, where if we look at the makeup of our GP Bullhound FinTech Index, we're still relatively heavily weighted towards payments. So you'll see, names like PayPal, Shopify, Square, Adyen, still doing relatively well and being the larger names in this index. But actually interesting what's happened in Q1 has been a real re-rating of Lending Club and Funding Circle, which I think over the last several years have not really been the sort of the darlings of public sector investors. But I think in particular, Lending Club, given that it acquired Radius February of this year, has kind of really driven a re-rating of that business, given that one, through the acquisition of Radius, it's been able to bring down its cost of capital quite significantly. So I think it's brought down its cost of capital from 300 basis points now to 35 basis points. So they're able to really now focus on profitability. And then equally, Funding Circle here in the UK and in the US has benefited a lot from the CBILS program and also the Paycheck Protection Program in the US. So I think, that the performance that we've seen in sort of Q1 for Lending Club and Funding Circle has really been driven a lot by, the movement to sort of working sort of the cost of funding for Lending Club, but also I think the government assistance for Funding Circle. And then I guess we've seen companies like Afterpay come off their highs a little bit. And my view is that's, I think, investors taking some profit in there, given that, at $30 billion market cap, the company sort of trading sort of around 50 times a revenue multiple. So it does feel like investors are taking profit there, not necessarily saying that that model perhaps is under question, or there'll be sort of less growth coming through that, especially given that in the private markets we just saw Klarna raise at a similar sort of valuation, lower sort of revenue multiple, but I think still a pretty strong revenue multiple. And then I guess the other one sort of to point out here is Zero, which has been sort of one of the laggards this quarter. And I think again there, it's been investors sort of thinking about their growth weight in the public sort of sector with regards to if potentially inflation is coming through, then again, rethinking their valuation strategies for some of the more growth-oriented businesses. But overall, I mean, we think payment businesses will continue to sort of drive the performance of fintechs. And it will be interesting to see sort of how the likes of Lending Club and Funding Circle trade through this period, in particular if we do see government assistance come down. And of course, how those loan books continue to sort of perform throughout the next 12, 24 months. But overall, we think it's still a pretty healthy market within the sort of the fintech community, and that sort of bears itself out what we're seeing both on the funding and M&A side. So if we can go on to the next slide. So yeah, so although the number of deals on the fundraising side have come down, actually the value for Q1 has seen a significant sort of uptick. In part, that was sort of driven by two large deals. So Klarna raising 1.3 billion, and then Robinhood, of course, raising that 3.4 billion for being able to sort of meet their regulatory requirements around sort of the increase in trading. But you've also seen, larger and larger rounds. So Mambu raising, $134 million at the beginning of the year. LendInvest raising lending capital, that was around 700 million. Nubank raising 400 million. Go Carless raising over 100. And quite a few other significant names that are raising larger and larger rounds of funding. And I think that to some extent is also an indication of investors focusing on more later stage businesses now, but also the flavor of the types of businesses that are now being funded. So I think we kind of see this trend of what we call embedded finance, where we would sort of categorize the likes of a Robinhood, a Nubank, Starling Bank, which sort of just raised under 380 million round in March. And I think this sort of theme of financial marketplaces, which I think Victor will sort of come on to Plum later on to talk about what he's doing there, but we see that as a growing theme that investors are sort of looking to back. And then on the M&A side, so I think a bit of a pause or a slowdown from the Q4 flurry of activity. And I think again, perhaps what's driving that in our view is a re-rating of valuation, but also corporates and owners trying to really understand the long-term dynamics or effects of COVID on their businesses. And I think people are perhaps pushing down those sort of M&A discussions until they have a better grasp of what exactly is a sustainable sort of future here for some of these businesses in a sort of post-COVID world. But nevertheless, I think we see a strong demand for fintech assets, both on the B2B and B2C side. And I think, just to reference again, our view that this sort of embedded finance theme that permeates across a lot of different sort of fintech verticals that we sort of see and operate, will continue to, I think, garner a lot of shareholder interest over the next sort of 12, 24 months. And of course, I think I'll hand it over to Adam now. But one of the key themes that we're seeing now is obviously, the resurgence of Bitcoin. So Adam, I'll hand it over to you, please.
Thanks, Claudio. And by way of introduction, my name's Adam. I'm a VP in the London team, where I spend the majority of my time working with Claudio on our fintech mandates. So we at Bullhound spend a lot of time thinking about trends in the market. I think rise of Bitcoin is certainly one that deserves some attention and commentary. As you can see on the charts, at the end of 2019, the price of Bitcoin stood at just over $7,000. By the end of 2020, that price had increased to $30,000. That's a 4x jump in 1 year. And today, the price of Bitcoin is increasing further, and it's around 60,000. This price increase makes Bitcoin one of the best performing assets you could have held since the beginning of the pandemic. And that's great for early adopters. But I guess the question is, what does that mean for the rest of us? So the question on my mind is whether this exponential rise in Bitcoin is yet another outbreak of speculative mania in the markets, or is it that Bitcoin is now crossing the threshold into mainstream adoption? So as a reminder, Bitcoin has been around for over a decade, but the big reason we're talking about it now has little to do with Bitcoin itself and more to do with the market environment that we're in. So in developed markets, policymakers are doing everything they can to generate growth and inflation, and as part of that, cash and cash-like assets are increasingly unattractive. For example, 30% of the world's investment-grade debt now has negative yields. And that causes a big problem for investors. So as a result, they're all being pushed to seek out new stores of wealth. If inflation is coming, you want to hold a real asset that can hedge against it. And typically investors have fled to gold. Gold's a great store of wealth. It's got a limited supply. It's relatively easy to transfer and exchange, especially in today's digital world. And Bitcoin shares some of these qualities. Definitely on the supply side, it's got a fixed supply, and the growth in supply is known. It's also very easily exchangeable, and it's entirely digital, so we can trade it globally. But on the flip side, it's got some characteristics that still prevent it from being seen as a store of wealth for investors. Beyond the risks surrounding regulation and compliance, for many, it cannot be sure if it's a good diversifier or inflation hedge, just given its relative limited history. So on that front, I think we need more time to see if it's, the patterns of market performance will prove out in the future. But having said that, on the next slide, we can see that institutional investors and corporates are starting to make some big bets. So MicroStrategy, a NASDAQ-listed enterprise analytics and software business, in August, they announced an investment of $250 million into Bitcoin. And that was as part of their capital allocation strategy, all aimed at maximizing long-term shareholder value. In December 2020, they then announced a further purchase of $650 million. And in February 21, they doubled out again, purchasing another billion of Bitcoin. So that takes their combined holding to $2.2 billion. And that's interesting when you think about, the combined market cap of MicroStrategy is only $7 billion. So 2.2 billion of that is held up in Bitcoin. Bitcoin's now so core to their strategy that the CEO has publicly stated that the company remains focused on its two core objectives. One, of growing their enterprise analytics software business, and secondly, of acquiring and holding Bitcoin. It's interesting that a company dedicated to forward thinking with access to some of the best analytical tools has made this bet. Similar bets have been announced by both Square and Tesla, and we expect other corporate leaders will follow suit in due course. Looking at activity in the public and private markets on the next slide, we had a significant uptick in this, particularly amongst crypto startups in both the public and private markets. In the public markets, there are some mega deals in the space, including eToro, the online investment platform that I'm sure many of you know. That went public via a SPAC in a deal that values the business at $10.4 billion. Similarly, Coinbase, the digital currency exchange, is also set to follow suit shortly with a direct listing. To be seen when that happens, but it's in the pipe. In the private markets, we had a flurry activity of late. Notably, this includes Fireblocks, which recently raised $133 million. And for those not familiar with the business, Fireblocks, it began life as providing the infrastructure for moving, storing, and issuing digital assets, particularly to crypto-native institutions and exchanges. But now, given the focus on the sector, it wants to start working with more traditional banks and fintechs, which are facing growing demand from customers to enable digital asset products and services. So we expect this level of activity in the sector has only just begun, and we look forward to seeing how it evolves in the coming years. And with that, back over to you, Claudio.
Great. Thank you, Adam. So now we move on to the company presentation part of the webinar. And before we kick that off, I'll just remind everyone that please, if you do have any questions, to submit them in the Q&A function, and we'll try and pick those off when we have our panel discussion. So first up is Victor, the CEO and founder of Plum. And Victor, over to you, please.
Hi, everyone. Despite not being able to see you, so I guess I'm going to be sharing my own slides. So just give me a sec. There we go. Great. So yeah, thanks for having me, guys. Claudio and Adam. Yeah, fintech continues to be interesting, and we still think there's a lot to be built. So I guess I'll jump into it. So I guess the fundamental belief at Plum is that, you know, we as a mass market, we struggle to build financial freedom and build up our wealth. And we believe that there's a big need for a partner for the mass market to manage their money, right? And the way we see the negative effects of there not being a product out there is that there's 100 million Europeans that have less than 2 months in savings. There's 120 billion that's lost in bad deals every year. And then there's a 40% drop in home ownership in like the 25 to 34-year-olds, right? So this is why we started building Plum. And the idea behind Plum is it's the automated financial assistant that effectively helps you multiply your money. We try to make it as easy as possible. So just by connecting your bank account, we start helping you grow your money. This year, we're at a run rate of adding around 1.2 million users to the platform. We're going to save people more than 1 billion this year, and we are already live in Europe, and we're going to be extending our rollout across Europe. The way Plum works is, and I think our focus is very much like, how can we make a user better off? And that is, every product we build has the intention of doing just that. And what's critical is that we allow people to connect their bank account, and the big value there is that they connect their primary bank account, which means we have primary account data, which means we can get a very good view of their financial picture, which means that we can then be in a much better position to help them. And the other important thing is that when we have this primary account data, it's all about automation of how we automate your money, because we also believe that people have this negative inertia to actually manage your money. So effectively what happens when you connect your bank account to Plum, the first thing that happens is you start saving money from day one. Then you can choose to invest that money to grow it. So you can open up an investment account with Plum and invest in one of our, like, we have like 9 publicly traded funds that either are like tech focused or like risk-based focused. Then we also look at your cost side. So we try to reduce your bills, right? And then finally, we're also building features around the budgeting side so that we help people control their spend and manage how much spend they have. So if we can do all of this, we believe that people can basically be 20% better off with their money, which is fundamentally kind of what we set out to do as a technology company. Just giving you a bit of a snapshot into like kind of like, you know, what happened, you know, I guess during 2020, the COVID year, and what's happening going forward. You know, I guess we look at our product between like recurring monetization, AUM, and lifetime expansion, like kind of immediate payback, which is the switching proposition. Over 2020, as you can see in the slide, we like, you know, made a lot of initiatives that kind of expanded our subscribers, our investors, and how much people were switching. And I guess 2021 is going to be super interesting for us because we're doing a lot in all 3 sectors. So we're introducing this third tier, which is very much focused on budgeting. To that, we're going to tie a card that people can spend on. We're live with pensions. We're going to be introducing stock trading and crypto. And then we're continuing to work on what we call lost money, which is basically helping people switch and manage their bills by doing direct integrations with lenders, building a credit card panel, and really working on that feature to help people see where their money's going on various bills and how to reduce it. In terms of growth, we've seen like quite substantial growth. So, you know, we're at 1.5 million users now in the UK. We're at a saving run rate of around basically close to 700 million. And with the growth, that's why we're going to save 1 billion. And then we've grown the business to 76 people during COVID, and continue to double that business in terms of in terms of employees by the end of the year. So this is what's happened during COVID for us effectively. Just to close off, you know, I guess just a tiny bit on me. I was one of the early employees of TransferWise, headed up their international expansion. I guess over the last year, we've managed to collect quite a good group of people to help us drive this further. Like Paolo was head of marketing for Uber pre and post IPO in LATAM. Thanos was leading product at Currency Cloud. Machu just joined us from checkout.com, where he led the fundraising there. And then Kish was early TransferWise. Charlie was head of partnerships at ClearScore, so he's helping us build up our whole credit card switching proposition, basically. So yeah, I mean, I guess that's all from me as to what like Plum does. I think like the space is, and I think what Claudio talks about embedded finance, we really see where the space is going is how can we build product and features that basically help people have more money. And you know, we obviously truly believe that that's going to be an ongoing focus, and companies that do that very well will have a lot of value to unlock for users, but also a lot of growth for them to build. And Europe, as we were chatting yesterday with Claudio and the guys, like Europe, I think is completely untouched in terms of like giving people access to helping them automatically manage their money and invest their money, which is why it's such a big focus for us. So yeah, that's it from myself.
Great, thank you, Victor. I'm sure there'll be a couple of questions following up post that, but really interesting business and presentations. Thank you for that. So following up, we have Roman from Ottonova. So Roman, I think it's over to you, please.
Thanks, Claudio. And in Germany, we started a health insurance, a digital health insurance. And our idea was we wanted to have the same customer experience and the same net promoter score as Apple or Amazon has it. And we've succeeded. We now have an NPS, net promoter score of 70 in 2 years following. And just want to give you a quick idea of what kind of people we made this health insurance for. And we'll show a video to see that.
Noch nie war die Welt so schnell wie jetzt. Noch nie war das Verlangen nach Einfachheit so groß wie heute. Noch nie mussten wir so gut funktionieren, immer performen, immer weitermachen. Noch nie hatten wir so wenig Zeit für uns.
Ottonova.
Es ist an der Zeit, das zu ändern. Hol dir deine Zeit zurück. Die Zeit, in der du nach einem Arzt suchst. Die Zeit, in der du auf dein Geld wartest. Die Zeit, die du in Wartezimmern verlierst. Die Zeit, die du mit Papierkram füllst. Hol dir Innovation. Tarife mit Bestnoten. Zufriedenheit. Gesundheit. Auch in der Zukunft. Ottonova. Reduced to the best.
So we've built this customer-centric digital health insurance in Germany in a market with lots of almost century-old incumbents. With a mobile-first approach, everything built on the greenfield, obviously a great IT system, data-driven efficiency, and everything developed fully in-house. And on the next slide, you will see, once we get the next slide, that's the specific thing about us is we need a license for health insurance. So we have a European license for health insurance, the first digital health insurance that has that. And we have that for full health insurance, as we call it, as well as for supplemental health insurance. In full health insurance, customers in Germany actually have a customer lifetime of about 50 years because you lose some money if you switch your health insurances. In the supplemental health insurance, customer lifetime is around 25 years. So you have a very low churn. It makes some sense to switch at the beginning, but not more after a couple of years. Have a high gross margin after claims. We spend a lot of money for the tech platform to get started. And if we switch to the next slide, we will see that we focused up to this moment very much on the B2C business models, selling full private health insurance and supplementary health insurance in Germany. But we also have some B2B offering. We already have a first B2B customer, another German health insurance, who basically took a dumbed down version of our app We didn't want to focus on that, so we started a joint venture there to sell B2B software tools. And we're starting right now in Q2 with white labeling our health insurance in Germany. So we can basically work together with other innovators and other groups that basically can then sell our digital health insurance under their name or in their sales network in a white label form. Next slide. So basically, we set out to revolutionize health insurance in Germany, and we did that. The proof is that we have this extremely high net promoter score. We have very low customer acquisition costs, and we are now ready to basically grow this business much more and to invest larger amounts of money to really become the next health insurance unicorn in Europe.
Great. Thank you very much for that, Roman. And next, I believe we have David Pope. Hi, David, from HooYu. So over to you, David.
Thank you. Let me just share my screen. Okay, so hopefully now you can hear me and see my screen. So let me tell you about HooYu. So we're a KYC RegTech customer onboarding platform. We've been in the market now for about 4 years. But the team and I, we've been together in one guise or another for the last 20 years. In fact, we started and scaled and exited our first identity verification business back in 2012, which we sold to Experian. But HooYu, what we're trying to achieve here is to build a global customer onboarding platform that isn't limited by traditional means of identity verification, such as databases. So in fact, what we do is to bring together a range of identity verification technologies that our clients can pick and choose from, and we wrap that up in a smooth UI and UX layer that they can then embed inside their site or their app to drive their customer through the customer onboarding process. So a bit more about how we work in a second, but briefly, let's just have a look at the market. And it's a very, very lucrative market with a high growth rate at the moment. And in fact, it's very much a perfect storm of conditions for identity verification businesses like ourselves. Firstly, everybody is digitalizing, whether it be companies like Plum in money management, whether it be in companies like Ottonova in insurance, whether it be lending, traditional banking, fintechs. So everybody is trying to create their digital business models. And this is something that's only been accentuated by COVID, but that trend started before COVID and will carry on well after it. At the same time, all these online businesses, they are forever being plagued by increasing amounts of fraud, increasing amounts of money laundering, trillions and trillions of pounds lost each year to money laundering. And as you might expect, that means that governments are regulating by response and mandating companies to spend money on protecting their customers and preventing fraud. And each year, there's more and more regulation that comes down the line, and HooYu is perfectly placed to take advantage of all that new regulation as well. So very, very lucrative market, but it's also a very, very crowded market. So the question is, how does HooYu differentiate in that crowded market? So this slide really explains the HooYu difference. So there's a lot of companies in identity. A lot of those companies only provide part of the solution to the puzzle. So what HooYu does is to orchestrate a wide range of identity verification technologies that our clients can pick and choose from, so they can then build a granular KYC process that is perfectly suited to the geographical requirements in terms of what the regulator says, or in fact the granular risk posed by that individual customer or product that they're trying to onboard the customer to. So once we've helped our clients to orchestrate their KYC process, we then turn that into a UI and UX journey that sits inside our client's site or app, and we give lots of guidance to the user to help them sail through the journey. We give them dynamic feedback if they've got a little bit lost or done something wrong. And we have engagement tools to be able to reach out to that user and bring them back into the process should they not complete there and then on that day. And the result is our clients, they have our client portal, which is where they can manage all their onboarding flows, analyze the success, look at the reports, trigger new journeys, and create new journeys at the same time as well. So that's really the three main pillars of the HooYu KYC platform. And so how are we doing? Well, as you might expect, we're seeing very significant growth at the moment, 80% revenue growth year on year. And we're closing in on 900,000 identity verifications that we run per quarter on behalf of our clients. So our clients in the main are in regulated sectors, banking, fintech, online gambling, and their customers, their users can be anywhere in the world. So we're verifying identities globally at the moment, although our focus very much so far has been on the UK, whilst 30% of our revenues are already coming from clients that are based outside of the UK. And so our next step, of course, is to expand into new geographies. That's very much a project that we're working on right now. So that was a brief summary of HooYu. Sorry for the technical hitch at the start. So Claudio, back to you.
No, great. Thank you for that, David. And there's always a little bit of troubleshooting these things anyway, so we're all used to that. And I guess with that, if you could stop sharing screen, David, that would be great. That sort of ends our formal presentation. So if I can have the presenters to sort of stop sharing screen and come on board. I guess what I'll do is I'll kick things off on my end. And, you know, I know that sort of everyone is to some extent a little bit sort of fed up with talking about sort of COVID. But one of the things that I think investors are keen to understand and hear is sort of now, you know, almost, you know, just a year past the lockdowns here in Europe and in the UK, what sort of trends can we see or have you guys seen that can really kind of be extrapolated as sustainable, you know, over the course of the last 12 months, really, that where we think there has been a, you know, a sustainable shift in the way that consumers or companies are buying or behaving, that we think can make our businesses more predictable or has shifted to improve the way that we think our company will create value. So maybe I'll kick off with you, Roman, given that, you know, health, of course, is front of mind for everyone.
Yeah, so in general, it has been good for us. On a macro level, it's easier to sell health insurances online in times of COVID. You know, the competition is not out there visiting people in their homes in Germany. And people also understand how important it is to be well insured. So that's been very helpful. On a micro level, we sometimes see that while on a macro level, business is up, on a micro level, we see that sometimes when there is the next lockdown, like currently with the third wave in Germany, then you see for some weeks actually especially supplemental sales again going down a little bit because of a loss of consumer confidence. And whenever there's a light opening, we see sales go up again as there's more consumer confidence. So
in that sort of, because I think we were talking about the fact that you know, a growing volume of your business is coming through that sort of supplemental health insurance. Is that sort of a broader coverage, or are people going or topping that up for very specific sort of health coverage?
Yeah, in Germany, 90% of the market is basically an NHS-like state-organized market, and with a bad dental coverage and a bad hospital coverage. So people will tend to buy insurance for better dental coverage or better hospital coverage.
Okay. And then Keith, perhaps the same question to you in terms of sort of long-term trends or shift that we've seen over the last 12 months.
Yeah, well, I mean, when COVID first hit, we were a little concerned as to what was going to happen, but we pretty quickly realized that it was going to accelerate our business rather than hinder it because of the push, particularly in financial companies, to digitize and bring people online, you know, virtually rather than face to face. So it's been, the last year's been really good in that respect. We operate in regulated industries, obviously, as Dave said, and you know, businesses have to continue to carry out their regulatory functions, so they have no choice but to spend money on KYC. I think what's happened though is because businesses were forced to maybe move more in this direction more quickly than they thought. The whole industry has matured a lot over the last year, I think. And what we're finding in particular is that customers are becoming more demanding about, not necessarily about the ID verification tools, but more about their configuration options, the ability to quickly, set up new customer journeys dependent on the level of risk that a particular customer set would pose. So we've in particular put a lot of energy into configuration tools, making it easy for a bank or a gambling company to integrate and to quickly set up new journeys dependent on risk profile. So we think basically the industry has become more mature more quickly, I think.
And is that the sort of the maturity point is an interesting one. Do you think that's being driven in part by regulators kind of shining a brighter light under?
Yeah, absolutely. It doesn't matter whether you're talking about the FCA in the UK, whether you're talking about the regulators in Germany. They are all becoming more prescriptive about what they require of regulated companies to do. And so, we spend a lot of time understanding the different regulations in different geographies, but also speaking to regulators to help shape, the next iteration of their regulations. So it's becoming more, as you say, a bigger spotlight has been shone over the last year for sure.
And do you think sort of a function of that or a byproduct of that will be sort of businesses like yours kind of focusing on more mature markets and sort of not necessarily going after, let's say less regulated markets or less sort of data centric markets?
Yeah, for us, I think we're certainly more interested in the regulated markets because, if you can build the right platform that satisfies the regulator, there's sort of a barrier to entry there. It's not obviously it doesn't prevent other companies doing the same thing. But as Dave said, the ID verification market in particular is pretty crowded. There's a lot of players out there. And many of them, provide, half solutions rather than full solutions when it comes to regulated markets. So regulated markets sort of have a bigger moat around them, I suppose. And as long as you can get across that moat, you're in good shape.
Yeah. And then I guess over to you, Victor. And I guess, we've been discussing this for the last couple of days. And, I think you and I were sort of talking about how historically it's always seemed that Europe sort of lags on the sort of investment side. And it was a question maybe of culture, exposure, but it seems like we're kind of, making or finally sort of turning the corner on that. I mean, what have you picked up over the last 12 months? Do you think it's an actual inflection point now for your business?
Yeah, I think there's a few factors, right, that are playing into this. I think one is that people have managed to save more because their expenses have gone down. But also, I think what's going on more broadly is that people are getting a bit more worried and more cautious about how they spend money in order to save for unforeseen circumstances, as the one that just happened with COVID obviously happening again. So there's been this push for people to save, and we've done some surveys, and it feels that a lot of people will be trying to keep on to those savings and not just splurge it immediately now once we open up. But I think in parallel with all of that happening, the combination of interest rates dropping further, Europe being negative, the UK being in any high street retail bank being zero, has effectively meant that people have started looking with alternatives, and the volatility in the markets, twice, I think, one with the big crash in last March and then kind of the swift recovery, and then the further GameStop incident has meant that those kind of events that kind of get a lot of public attention in the media, even though they're hyped, do introduce this alternative way to grow your money to the mass market, which I think is what we need for people to start dipping their toes in and trying out investing, right? And so we've seen a genuine significant increase in the percentage of people that are using our investment feature because both they have more money to spare, but also I think primarily because there's the negative rates and investing has become a more viable option. So, you know, we think savings will look differently in the future. It is not going to be sticking money in your bank and hoping to get a return. And I think we're definitely on that trajectory for a lot of reasons, and it will continue. And I think it's a very small percentage of the population that actually does that in a consistent manner right now.
And you kind of mentioned, you know, new products and sort of pensions being one of them. And I mean, do you think that that's one of the key categories to sort of insert into your suite of solutions in order to sort of either bring, you know, AUMs higher or get a better, stickier cohorts of clients? I mean, I'm sure you saw the announcement today by PensionBee that they're sort of looking to IPO here in London. And I think people have always sort of, rightly or wrongly, made a differentiation between sort of investment platforms like yours and sort of pension managers like PensionBee.
Look, I think I think especially in the UK, pensions are a very interesting, let's say, category because of what happened in the regulation that everyone has to be enrolled in a pension as of the last 4 years, which means we'll have a scenario where people over their lifetime will have multiple pension providers, and they need a place where they can kind of see all of their money, all of their pensions, consolidate them together, control them, and have visibility. And I think that government move has meant that a lot more people have pensions. And, you know, look, our goal is to get people to have an overview of their money, and the pension pot is a significant pot of money for the majority of people, right? It's probably their only investments, right? So yeah, for us, it's interesting though, because we're helping people save more holistically. And as part of that holistic proposition, you can also transfer your pensions into Plum and see them next to your savings and investments, right? So I think that's, and you talked about embedded finance, and I think that's the way that the products will develop versus necessarily just acquiring a pension user, because the services that you're adding, you're not trying to invest people's money with great alpha when you're offering a pension. You just want to give people visibility and have them like stick into a long-term investment. So I don't think you can really attract people if you don't have something a lot more holistic and you're just offering a pension product.
Yeah. And just on this point of sort of growing uncertainty and risk, I guess, Roman, you kind of mentioned that, you know, you've seen kind of people perhaps, you know, volumes declining or not growing as quickly as you have seen before with the sort of third wave happening. You know, do you feel like you guys need to be more sort of A/B testing around the price elasticity of the product? Because I guess instinctively, I thought, well, if there's a third COVID sort of wave, people would probably want to spend more on insurance or feel more protected given the heightened uncertainty. But it sounds like it's the opposite. You're on mute, Roman.
Had to do this for at least one time. So I think maybe I was misleading a little bit. What I did tell you, there's this macro trend that more people are going online to buy this, and there's a micro trend on top of this macro trend that, you know, so the weeks where there is like more of a lockdown, we sell less, but still more than last year, you know. So first of all, so there is a consumer confidence question in some ways, and then there is the that people are thinking more about health insurance now and are more able or willing to make long-term decisions even online. To your point of price elasticity, unfortunately, that is not feasible in our regulated industry. The tariffs are quite clearly calculated, and you have to show it off to a group of people and talk about it with BaFin, and then once you have the price, that's the price. And the nice thing about this regulation is once the costs go up, all health insurances in Germany are actually forced to raise their prices. So there is actually no health in Germany that is losing money. So that's the good news of that. But the bad news is no price elasticity there, you know, that we could use in day-to-day business.
Good. So while I have you, Roman, and why don't we go on to some of the Q&A coming from the attendees? And you've answered some of these, but I guess for the benefit of the broader group, you know, one of the attendees sort of asked, you know, what's the benefit of having the white label strategy? Doesn't that compete sort of with your B2C brand?
Yeah. So basically, there's a group of people that we can reach very well with our B2C. That we market to over Facebook, YouTube, whatever, and that also find us in comparison portals and like us, or that watch television commercials and then go directly to our direct channel. But there's other groups, like if you have a digital broker who already has his group, the group of customers very, very well fenced in, and that digital broker will actually offer a product that is our product. We gladly share some of the revenues with that digital broker, because it's actually business on top of the business that we could have without it. So
is that part of your sort of expansion sort of strategy as well, sort of that white label piece? So you don't necessarily need to be direct in every other European market?
Yeah. So I think internationalization and white label, are two different things. Different ways to slice the cake. So obviously, different white label could also help with internationalization. If you look at going to other markets, and that was the other question that I answered offline. We are quite happy in the German market because it's big, and then even if we having a European license doesn't mean that it's really easy to go into a new market. You still have different regulators, different ways to sell health insurance, different way that customers are used to things. But I agree with your point that if you have good white label partners, that might also help your internationalization strategy. Yeah.
Yeah. And a question we had from another attendee, Victor, was sort of around your gross margins. So I don't know if you can disclose sort of what level you're operating at the moment.
Yeah, I can't really. Anyway, we're operating a very healthy, positive gross margin. So our business is very different to a neobank kind of business. Our costs of operating are extremely low. We do payments via direct debits. We have a bank account connection that brings the feed in, which we could build ourselves, that brings that down to zero. Yeah, and so our margins are very, very healthy.
Okay.
Sorry.
Good answer.
But it's very different to others. Yeah.
I think with that, gentlemen, we can bring to a close. I think we're sort of still within the time frame that we allotted. So thank you, Victor, Roman, David, and Keith for presenting today. And for those of you attending, we'll have a recording of this webinar live on our website soon. But thank you again, gentlemen, and thank you everyone for joining.